Chapter 4. Completing the Accounting Cycle. A worksheet is not a required report, yet using a manual or electronic worksheet has several potential benefits. Specifically, a worksheet 1. Aids the preparation of financial statements. 2. Reduces the possibility of errors. 3. Links accounts and adjustments to their impacts in financial statements. 4. Assists in planning and organizing an audit of financial statements. 5. Helps in preparing interim financial statements. 6. Shows the effects of proposed transactions. Here is the spreadsheet we will use for Fast Forward. We have a set of 2 columns for the trial balance information prior to making adjustments. We often refer to this as the unadjusted trial balance. The unadjusted trial balance will be combined with our adjustments to arrive at the adjusted trial balance. The adjustments have been entered on the worksheet in the appropriate columns. Let's look at Adjustment A. This adjustment is made to record the expiration of prepaid insurance during the month. The entry is to debit or increase insurance expense and to credit or decrease prepaid insurance. You may want to go over the other adjustments. Notice that the total debits and total credits are equal in the unadjusted trial balance and the adjustments columns. We can now combine the balances on the unadjusted trial balance with the adjustments we prepared. The result of the combination is the adjusted trial balance. You can see that the prepaid insurance account balance was reduced from $2,400 to $2,300 as a result of our adjustment. The insurance expense account went from $0 to $100. We have to be careful and combine the amounts properly, or an error will result. The adjusted trial balance shows that the books are still in balance. We have added 4 more columns to our spreadsheet. We take the information from the adjusted trial balance and prepare the income statement. Once the income statement has been completed, we can prepare the balance sheet. The totals in the 2 columns for the income statement have a total for expenses in the debit column and total revenue in the credit column. Net income is the difference between the 2 amounts. Notice that we have added 2 rows to the bottom of our spreadsheet that must be completed. Let's see how we prepare the income statement and balance sheet. First, we subtract total expenses of $4,365 from total revenues of $8,150 to determine net income of $3,785. We move the income to the debit column so that our column totals will be the same. We are not implying that income has a debit balance, but simply that when we put it in the debit column, we get the totals straight. Next, we move net income to the credit side of the balance sheet because we know it will increase the owner's equity account. To make sure it appears in the proper side of the balance sheet, we place net income on the credit side of the balance columns. By doing this, you can see that our balance sheet is in balance. Using an electronic spreadsheet saves us a great deal of time and effort. The math is automatically recalculated, and we can make sure the books remain in balance. We encourage you to use this type of spreadsheet where appropriate to complete your homework assignments. After the worksheet is complete, we can prepare the formal financial statement. All of the amounts on Fast Forward's income statement are taken from the income statement columns on the worksheet. After completing the income statement, we prepare the statement of owner's equity. Once again, we add the net income and investment amounts together and subtract any withdrawals to arrive at the ending capital balance of $33,585. Once the income statement of owner's equity is prepared, we are ready to prepare the balance sheet. The balance in Chuck Taylor's capital account appears on the balance sheet in owner's equity. The assets and liabilities are taken directly from our worksheet. The balance for total assets and total liabilities plus owner's equity do not equal the balance that appears on the worksheet. This is because we show the accumulated depreciation, a credit balance account, as a reduction in equipment, a debit balance account. The closing process is an important step at the end of an accounting period after financial statements have been completed. After the formal financial statements have been prepared, we may begin the process of closing the books and getting ready for the next accounting period. Income is earned over a period of time. At the end of the time period, we start over and calculate income for the next period. The closing process has as its goal to reset all revenue, expense, and withdrawal accounts to a zero balance at the end of the period. By doing this, we can start the next accounting period fresh. We will use a temporary account called Income Summary to facilitate the closing process. The account will never appear on any financial statement and will have a zero balance when the closing process is complete. All accounts that will be closed are known as temporary accounts. Temporary accounts include revenues, expenses, withdrawals, and the income summary. These accounts should all have a zero balance at the end of the period. Permanent accounts include assets, liabilities, and owner's capital. These accounts are permanent in nature because they are carried forward from one accounting period to the next. Part 2. Remember, the closing process only applies to temporary accounts, revenues, expenses, withdrawals, and the income summary. Here are the 4 steps we always follow in the closing process. First, we close all revenue accounts to the income summary. We move the balance in all revenue accounts from the account to the income summary. This process will cause all revenue accounts to have a zero balance. Remember that revenue accounts normally have a credit balance. Next, we close all expense accounts to the income summary. This will zero out all our expense accounts. Expense accounts normally have a debit balance. Next, the income summary will show revenues and expense, or net income. We must close the income summary, which contains net income, to owner's capital. This process zeroes out the income summary. The final closing entry will be to move the owner's withdrawals to the owner's capital account. This will cause the withdrawal account to have a zero balance. Let's see how this process works. To prevent confusion, when you first try to make closing entries, it is an excellent idea to follow these 4 steps exactly. Let's use the adjusted trial balance for Fast Forward and prepare the necessary closing entries. We will follow our 4-step approach. Our first step is to close the 2 revenue accounts. Since they have a credit balance, we will debit the accounts to zero out the balance. Let's look at the closing entry in the journal. To close the accounts, we debit consulting revenue for $7,850 and debit rental revenue for $300. The credit to income summary is for the total of $8,150. Let's see what the ledger will look like after the closing entry is posted. The balance in both revenue accounts is now zero, and all revenue has been transferred to the credit side of the income summary. Our second step is to close all expense accounts to the income summary. Let's make the journal entry. We credit each expense account for its adjusted balance and debit the income summary for the total of $4,365. Let's look at the ledger accounts after posting this entry. We have a zero balance in each expense account and have transferred total expenses of $4,365 to the debit side of the income summary. The difference between revenues and expenses is net income of $3,785. Next, we close the income summary to owner's equity. Our goal is to update the balance in Chuck Taylor's capital account for the income earning during the period. Let's make the next closing entry. We debit the income summary for $3,785 and credit C. Taylor Capital for the same amount. Now we have increased owner's capital for income earned during the period. We can see that the balance in the income summary is zero, and the balance in the capital account has been updated. The final closing entry is to close withdrawals to owner's capital. Let's take a look at the journal entry. We debit or reduce owner's capital by $200 and credit the withdrawal account for the same amount. The withdrawal account now has a zero balance, and once again the owner's capital has been updated to the balance of $33,585. This balance appears on the balance sheet of Fast Forward. After all four of our closing entries have been made, we prepare a post-closing trial balance. This trial balance should show only permanent accounts, that is, assets, liabilities, and the capital account. All the revenues, expenses, and withdrawals have been reduced to zero balances. Take a close look at our post-closing trial balance and be sure that we have only permanent accounts. Our books are still in balance after the closing process. The owner's capital account is shown with its updated balance of $33,585. We are now ready to move into the next accounting period. Explanations. 1. Analyze transactions. Analyze transactions to prepare for journalizing. 2. Journalize. Record accounts, including debits and credits, in a journal. 3. Post. Transfer debits and credits from the journal to the ledger. 4. Prepare unadjusted trial balance. Summarize unadjusted ledger accounts and amounts. 5. Adjust. Record adjustments to bring account balances up to date. Journalize and post adjustments. 6. Prepare adjusted trial balance. Summarize adjusted ledger accounts and amounts. 7. Prepare statements. Use adjusted trial balance to prepare financial statements. 8. Close. Journalize and post entries to close temporary accounts. 9. Prepare post-closing trial balance. Test clerical accuracy of the closing procedures. 10. Reverse. Optional. Reverse certain adjustments in the next period. Optional step. See Appendix 4A. A classified balance sheet is the most popular format used by business. On the asset side of the balance sheet, we group assets as current or non-current. A current asset is one that is expected to be converted into cash in 1 year, or the company's normal operating cycle, whichever is longer. The operating cycle of a company is the time it takes to acquire inventory, sell the inventory, and collect cash. For many companies, the operating cycle is less than 1 year. These companies would classify an asset as current as long as that asset is expected to be converted into cash within 1 year. On the liabilities plus equity side of the balance sheet, we divide liabilities between current and non-current. A current liability is one we expect to be paid out of current assets of the company. Let's see how new classifications appear on the balance sheet. Current assets normally include cash, short-term investments, accounts receivable, merchandise inventory, office supplies, and prepaid expenses. Short-term investments are expected to be sold within 1 year, or the normal operating cycle, whichever is longer. Merchandise inventory contains inventory items we expect to sell to customers in the normal course of business. For a service business, like an attorney, we would not expect to find a merchandise inventory account. The next major section of the classified balance sheet includes long-term investments, meaning those we expect to hold for more than 1 year. Some common long-term investments include notes receivable, investments in the stock or bonds of another company, and land that a company is holding for a future plant site. Companies often purchase stock of another company in order to control or own the other company. The third section of the classified balance sheet shows our property, plant, and equipment. This section includes productive assets of the company, along with any land containing structures, such as buildings. Productive assets include machinery, equipment, furniture and fixtures, and buildings. Productive assets are normally depreciated over their useful life. The cost of the asset less any accumulated depreciation is called book value. We do not depreciate land. The final category of assets on the classified balance sheet includes intangible assets. Intangibles include long-term resources that lack physical form. Accounts like patents, copyrights, trademarks, and goodwill. In general, it is very difficult to properly value intangible assets. In summary, we have current assets and non-current assets that are divided among long-term investments, plant assets, and intangible assets. Current liabilities normally include accounts payable, wages payable, short-term notes payable, and the current portion of long-term liabilities. Long-term liabilities include long-term notes payable, net of current amounts due, mortgages payable, and bonds payable. We will look at the accounting for long-term liabilities later in the text. As we have seen, the equity section of the classified balance sheet includes the updated owner's capital account. Remember that almost all companies publish a classified balance sheet. The current ratio of a company gives us a good indication of the company's ability to pay its debts when they fall due. The current ratio is calculated by dividing current assets by current liabilities. You can see from the chart that the current ratio of Limited Brands has decreased from 2004 through 2007. In 2004, the company had a stronger than average current ratio. With the decline in its current ratio, Limited Brands has fallen below the industry average current ratio. End of Chapter 4.